Has the market completely divorced the economy? You may be confused why the market is up almost up to a level where we were prior to the pandemic. It doesn't make any sense whatsoever because economy-wise, we're in pretty bad shape. We're looking at millions of job losses, we're looking at businesses filing for bankruptcy, the Fed printing money like crazy because they need to do whatever it takes to save the businesses. The IMF is calling for a long-term global recession, and at the same time, the market is up. It's like completely disjointed from the economy. And this can be super confusing, especially to a beginner investor. I can definitely see some of you also being a little bit frustrated with all this market volatility. As a matter of fact, I came across this Reddit post. This guy was so confused what to do with his money, whether he should stay in cash and risk hyperinflation or actually invest in the stock market, but then he can't stomach the volatility. So I thought many of you can probably relate to these questions, and I want to dedicate today's episode to answer those questions and hopefully help many of you watching. So let's dive right into it. Hey, what's up you guys, it's Kirk here with another investing video. If you've been following the news and the markets, you have seen that the S&P 500, the Dow, the Nasdaq, all have been going up steadily as if we have recovered and things are back to normal. However, things are not back to normal. Even when we're trying to reopen things up, things are barely back to normal. So I really like the way Chamath put this kind of what I call phenomenon on his latest CNBC interview a few days ago. And let me play you a very small segment of the video.
There was any doubt before, there should be no doubt now that we have completely divorced the economy from the stock and the bond markets. And, the Fed has been the principal agent of that obfuscation.
The problem is that it's a blunt instrument to a large degree, and while you'd love to make the stimulus, if you will, more effective or get it to the right people, we don't have a system of government that necessarily is, at least can or is willing to do that.
The reality is that we do have a system, and you don't have to pick who the quote-unquote right people are. The right people is every citizen of the United States. And I've said this before, but this is a point in time where direct fiscal stimulus should be going to the hands of U.S. taxpayers. It is the most effective way to blunt this unnecessarily rampant asset inflation in the markets and at least balance it with incentives in the hands of consumers to buy things. And if you don't break this cycle and teach a new pattern of behavior, we're going to be looking at a Japanese-style deflationary period where we'll have 10 years of unemployment, the economy will just be stagnant, and we'll wonder why equity markets keep going to all-time highs when it doesn't actually map to what you see in the real world on a day-to-day basis.
Now, if you don't know who Chamath is, look him up. He's a well-respected billionaire, and I happen to agree what he's saying in this particular interview. He has been very blunt and open in criticizing some of the decisions and actions that have been taken, which is not very common. People usually on those media channels are often either not telling the way things are, or they simply are trying to invoke people to trade. So I want to highlight what Chamath is saying here. Basically, he's saying we have absolutely no correlation between the state of the economy and the market. Stimulus packages are not addressed to the right targets. That is the people, the small businesses. People are fearful, not knowing what to do, or stacking cash, and this ultimately is not helping the economy. But let me go back to the Reddit post, and I want to address a few things from this guy's post. So the very first point here is, he says, if the stock market doesn't collapse, the US dollar will. It's one or the other. I really hope it's the stock market. I'm losing sleep over this. Alright, so there is this issue that I don't see it as an either or, to be honest. I think both are going to be affected and likely going down. The stock market will eventually, and I don't know when, nobody knows when, it'll level set with the reality and the economy. So it will most likely drop, maybe it will go lower than what it was in March and April. That is the likely scenario for the next few months. The US dollar, on the other hand, is also going to likely suffer because the Fed is trying to help the market and stimulate some of the businesses, so they've been printing a lot of money. And the act of printing that much money, trillions and trillions of dollars, actually triggers all kinds of issues. A likely scenario is a hyperinflation. And by the way, I already made a video about the risk of getting into hyperinflation and what are the things that we can do to protect ourselves. So I will link to it in the info card of this video and also put it in the description, so make sure to check that out. The second point that the guy says here is, he says, why is everything a gamble? Real estate, stocks, bonds, US treasuries, even leaving your money sitting in a savings account is a gamble. Now I get that it can easily seem that there is no good option here, but let's be clear about a couple of things. First of all, putting money in the stock markets has some risks for sure. But long term, again, depending on what stocks you're buying and holding, you have the potential to make anywhere between 7 to 8%. Historically, that's what stocks have been making on average every year. And what is the alternative here? Putting your money in the bank? And if you put your cash in the bank, in a savings account or in a CD, it's not really a gamble, that's true. The money is FDIC insured, so you can sleep at night. That's all great. But you're kind of losing money over time. Let me explain. So if we take a look at the current CD rates on bankrate.com and compare what you'll be making if you put your money into a CD, you'll see that the rates are anywhere between 1% to maybe 1.5%. Anywhere in between that number. So for a $10,000 amount, we're looking at what? A return of maybe like $300 or so, anywhere around this amount, and that's for, let's say, 1 or 2 years at least, the money being put into the CD. You can't take it out at any point. So that being said, you're making maybe $100 or $200 a year on a $10,000 deposit, and that's not a lot, guys, because that's just 1 or 1.5% growth of your money. And if you think about it, inflation usually is anywhere between 2 to 3% a year. So your money is not even able to match the inflation. And let's not even talk about the fact that, for quite a long time, we even had less than 1% returns on CDs and deposits. So, you're not really getting to the inflation rate here. What happens is that you're actually losing money over time. You're not even able to protect what you've accumulated, what you've saved, through your hard work. So that being said, I'm not sure that stashing your money in the bank is really a long-term kind of investment alternative. Now you can put money into a CD, into a deposit. If you will be needing the money for the next year or two, that's perfectly fine. That's where you would put your emergency fund for sure, but not your long-term investment. So the third point that the guy makes is, he says, we just want $1 USD today or $1 today to be worth $1 tomorrow. What did we do to deserve this? All right, so this is not possible, guys. If you know how the economy works, we need inflation to properly function and to properly grow our economies. So deflation is bad, hyperinflation is bad, but standard inflation of 2 to 3% is healthy. And we should never expect that our dollar today would be worth the same tomorrow. So this is why it is very, very important that we know how to manage our money and how to invest, A, to protect what we have, and B, to grow what we have accumulated. So what is my advice to you? My advice to you is to not be frustrated, to not be emotional. You need to be completely disconnected from what the market is doing. You shouldn't worry about the market swings. The best thing that you can do as an investor is to think long-term and to be non-emotional. If you can eliminate two feelings, greed and fear, you're going to be a successful investor. All you need to do is you need to be able to stomach, in the long run, the ups and the downs of the market. Meaning, you buy high-quality stocks and you hold them as long as you can without selling, and you will come ahead. That's what successful investors do. Investors who are very emotional, who can't stomach the up and downs, they end up selling usually at the wrong times, and they get very, very disappointed. And they get frustrated with this game of investing in the stock market. It's not a game, but it's actually a way to really grow your wealth. But you need to stomach all the ups and the downs. That's what it comes down to. Alright guys, I hope this video helped a bit and gave you the right mindset how to invest during volatile times, especially when the market is completely disjointed from the economy. If this video helped a bit, make sure to give it a thumbs up. obliterate the like button because that's the only way to let other people know about this video's existence. And if you're new to the channel, make sure to subscribe and hit the bell notification icon so I can notify you every time I post new videos on investing and personal finance. So until next time, stay the course and keep your emotions in check. That is, don't be emotional when it comes to investing.